This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Okay, we're now going to go through the first of several chapters on what we call group accounts. And what it is suppose we've got one company that controls another company. Now, I'll talk later about the precise definition of what we mean by control, but the most obvious case and the normal case is where one company owns the majority of the shares in another company. So maybe my company owns your company. We're two separate companies, and so we both produce our own sets of accounts. In law, we are completely separate. But to show a sort of fair position, if my company owns your company, then effectively it's as though there is one big company effectively owned by my shareholders. And so we are required to produce a third set of financial statements as though it is effectively one big company. And several problems can occur, but let me show you what I mean by that. We'll start with a very simple one, and then we'll go through more examples bringing in the various problems. So look first of all at example 1. It says on the 1st of January 2008, P acquired 100% of the ordinary shares of S, which was incorporated on that date. So S was formed on that date, on the 1st of January 2008. That's when S was started. And on that date, P bought 100% of the shares. We're now a few years later, on 31st December 2010, the statements of financial position for each of the two companies were as follows. Now for this one, I've actually copied out the example, then I can stress things. But we have two separate companies. In law, they are separate with two separate statements of financial position. And you can see P has non-current assets 25,000. Investment in S, they bought shares in S, the other company, and so it's an asset like any asset in P's statement. Current assets 8,000, share capital 25,000, retained earnings 15, current liabilities 3. So all perfectly normal. Separately, S, I keep stressing that this is a separate company. They've got non-current assets of 12, current assets of 9. The share capital of S is 10,000. Retained earnings, remember they were formed in 2008, but we're now December 2010. So they've been earning money, they've got returned earnings of 8,000 and current liabilities of 3,000. So two perfectly normal statements of financial position. Now just one bit of terminology. Because P owns company S, we call P the parent company. Oops, that's P. And S is the subsidiary. So the parent is the company who's controlling the other company. The subsidiary is the company that's being controlled. Well, again, we have those two separate companies, two separate statements of financial position. But because P, in this case, owns all of S, effectively, the shareholders in P own everything in both companies. And so, as I say, we are required to produce an extra statement of financial position, showing it as though it was just one big company. Before I do, just one thing. It may seem obvious, but let's just check. How much did P pay? The cost to P? We get from their statement. On their statement, it says investment in P at cost 10,000. And however obvious it may seem, because of things that are going to happen later, what did they buy? Well, they bought 100% of S's shares, and so the shares in S at 10,000. At the date it was incorporated, which is when P bought the 100%, at that date the value of S was 10,000. They simply issued some shares. They'll have just had cash of 10,000. And so, if you like, it checks. I said, however obvious that may have been. You'll see why I'm doing that later. Having said that, let's now produce the consolidated statement of financial position. That's what we call it when we produce this statement as though it's one big company. And if we treat it as one big company, the non-current assets, add them up. In total, the two together own 37,000. The current assets, add them up, a total of 17,000. And so the total assets of the combined company, 54,000. Who owns that company? It's the shareholders in P who own everything. And so the share capital of P is 25,000. The retained earnings, add them up. P has earned 15,000. S, which is owned by P, since the day we bought it, has earned 8,000. So in total, the earnings belonging to our shareholders are 23,000. And the current liabilities, again, as though it's one big company, 3 plus 3, 6,000. Let's check it adds up. 48, 54,000. And there we are. Notice that the investment in S of 10,000 has disappeared. All we've done is replaced that with the assets and liabilities that are owned by S. But again, there we are. So it's one big company. And appreciate it's P's shareholders who own all of it. They own P and P owns S. So the share capital, the consolidated statement, is 25,000. We've brought in all the assets of the two companies, all the liabilities of the two companies, and the retained earnings. Obviously, P's shareholders are entitled to P's profits. They're also entitled to those that have been earned by S because they own S. I beg your pardon. Okay, so that was a nice easy one, or I hope it was. As I keep on saying, we've prepared that statement as though it's one big company. Remember, in law, it isn't one big company. In law, there are two separate companies. P, S, individually, they'll be paying tax and so on. But just to give a fair view, accounting standards require us to produce this consolidated statement. All right, well, I said earlier, there are several problems that can occur, and I'm going to build them up gradually. The first one thing that made that example a bit, if you like, too easy, is P bought 100% of S's shares, and they bought it on the day that S was formed. And so on the day S was formed, we paid 10,000. That was the share capital of S, and there we are. However, look at example 2 on the next page. P again acquired 100% of the share capital of S, so P owns all of S, on the 1st of January 2006 for 28,000. at which date the returned earnings of S amounted to 8,000. Example 2 we're on. So this time, S already existed. I don't know when S was incorporated, when it was formed, but it's obviously been formed before January 2006 and had already been earning profits. On the 1st of January, when we bought it, they'd already earned 8,000. On 31st December 2009, the company statements of financial position were as follows. So, very much like before, but P, non-current assets 55, the investment, they'd paid 28,000. Current assets 18. The share capital of P 60, retained earnings 38, current liabilities 3. What about S, the subsidiary? As at December 2009, the non-current assets were 25, the current assets 14. The share capital was 20, and the retained earnings have now grown to 15,000. Remember at the top line, in January 2006, when P bought their shares, S had already earned 8,000. We're now at 2009, with more retained earnings. No surprise, it's now 15,000, and the current liabilities are 4. Well, again, just let's check what P was paying for. The cost of the shares. We know how much they paid. Partly it's in the first line, but also look at P's statement. It says investment in S at cost. They paid 28,000. And what were they paying for? How much was S worth at the date they bought it? Well, the share capital of S at the date they bought it, presumably it was the same as it is now, which is 20,000 on S's statement. But they paid more because at the date they bought it, S was worth more because S already had retained earnings. And what were the retained earnings when they bought it? Top line, it says 8,000. And so, at the date P bought the shares, S was worth 28,000. The share capital plus the retained earnings. S must have been worth 28 because, of course, the share capital plus retained earnings is always going to be equal to the net assets, total assets minus total liabilities. Now, just one bit of terminology. Those retained earnings are the retained earnings at the date P bought their shares. It's what had been earned before the date of purchase. We call them the pre-acquisition retained earnings. Pre-acquisition, before acquisition. That's what they'd earned before we bought the shares. And that's why we paid a total of 28,000. It checks. Now let's do the consolidated statement of financial position. And very much like before, produce it as though there's one, as though it's one big company. And so non-current assets, we simply add up. 55 in P, 25 in S, so a total of, what is it, 80,000? Ignore the investment in S because, like before, instead of showing the investment in S, we're bringing in all the assets and liabilities of S. But current assets, again, add up. 18 in P, 14 in S. So, for the group, as one big company, a total of 32,000. Carry on down. Share capital. Well, again, like before, it's the shareholders in P who effectively own everything. The shareholders in P own P, obviously, and P owns S. And so it's the shareholders in P, the parent company, it's their share capital that we bring in. Retained earnings. I'll do little workings here because what retained earnings are belonging now to the shareholders of P, I beg your pardon. Obviously, all of P's retained earnings, 38,000. However, as far as S is concerned, although the retained earnings are now 15,000, they weren't all earned since P bought the shares. Because again, 8,000 had already been earned before P bought the shares. It was pre-acquisition, and that was part of what we paid for. The reason we paid 28 was because we were buying the profits they'd already made. And so all we bring in the consolidated statement is S's profits since we bought the shares. And how much are the retained earnings since we bought the shares? Surely they're now 15,000. But on the date we bought the shares, they were already 8,000. And so, since we bought the shares, they've only earned the difference of 7,000. That's the amount belonging to P shareholders. Now, that's just workings, obviously. We don't actually show that on the statement. But the total retained earnings, 45,000. So to be clear, the retained earnings always are all of P's. But as far as the subsidiary is concerned, it's the earnings since the date of acquisition. And we call them post-acquisition retained earnings. Now again, we don't show the workings on the statement. We just bring in the 45,000. But it's all of P's plus the post-acquisition earnings of S. Finally, there are current liabilities. Add them up. For the big company, the total 3,000 plus 4, 7,000. Does it check? 60, 105, 112,000. And there we are. So there's the first, what you might call little problem. They were already incorporated, they'd already had earnings in the subsidiary. And see what I've done. The amount we paid for the shares, or P paid, they were paying for the share capital and the pre-acquisition retained earnings, the amount that had already been earned at the date of purchase. In the consolidated statement of financial position, we bring in all the assets, all the liabilities, the two companies added together. Share capital always is the share capital of the parent company. And the retained earnings, all the retained earnings of the parent. But for the subsidiary, It's the retained earnings since the date of acquisition, the post-acquisition retained earnings. All right, so that's dealt with one problem. I'll stop this lecture here, then again, otherwise it just gets too long. Check you've, go back through the lecture if you need, or back through the notes and check you understand what we've done. In the next lecture, I'll start going through the extra problems that can be